everyone. Welcome. Position management webinar today. A bit different what we used to. I'm going to discuss a lot about psychology of a trader, to be honest, and then demonstrate things on MT4. But yeah, it's a webinar that doesn't have a lot of notes, doesn't have a lot of slides. Actually, has 3 or 4 slides the max. So it's more of a webinar that I want you to hear my perspective, the way I believe that we're doing mistakes and we're driven by our emotions and by our psychologists traders. And I will try to show you actually ways to other than to try and keep your trading emotionless. Also, way to, once you achieve that, ways to manage your position in an effective way in order to avoid major losses, in order to be avoid to lose a lot of money, and etc. So position management is correlated with risk management. It's the same thing. We could say not precisely the same thing, but they are strongly correlated. It's a part of risk management. It is a part of risk management. So it's a very, very important important part of your, it should be a very important part of your trading. So okay, how we start? Let's, as usual, I would like to make sure that you can hear me loud and clear, right? Please let me know whether you can hear me loud and clear. Second, I have to go through the disclaimer warning as usual until I got an answer from you guys that you can hear me. This webinar is recorded as usual, so you're gonna receive the recording afterwards. Okay. So disclaimer: this material is provided as a general marketing marketing communication for information purposes only. It does not constitute independent investment research. Nothing in this communication contains or should be considered as containing an investment advice or an investment recommendation or a solicitation for the purpose of buying or selling of any financial instrument. All information provided is gathered from reputable sources, and any information containing an indication of past performance is not a guarantee or reliable indicator of future performance. Users acknowledge that any investment in leveraged products is characterized by a certain degree of uncertainty, and that any investment of this nature involves a high level of risk for which the users are solely responsible and liable. We assume no liability for any loss arising from any investment made based on the information provided in this communication. This communication must not be reproduced or further distributed without our prior written permission. Trading leveraged products such as forex and derivatives may not be suitable for all investors as they carry a high degree of risk to your capital. Please ensure that you fully understand the risks involved. Take into account your investment objectives and level of experience before trading. And if necessary, seek independent advice. You can find our risk disclosure and our legal documentation in the website. Feel free to find anything that you want. You have already confirmed me that you can hear me loud and clear. Thank you for that, Diara Deoba. And if you have any questions, please, here's my email address. It's me, Stuart, and the support team that will reply to these questions. So anything you need, screenshot of your MT4, just a general question, anything, we're here to help. So webinars@hotforex.com is our email address. Victor, you can get the recordings automatically, because what we do, because you have attended the webinar already, you're gonna the team has already your email address. So once we are done, and once we upload the recording to the YouTube channel, we're gonna send you a link via email. Okay, so don't worry about it. I will move on. I'm not gonna introduce myself. I think the most of you, I've seen your names again, so you have participated in my webinars before, so I'm not going to spend time introducing myself. So this is what we're going to cover today, guys. Okay. So pretty much what is today's webinar? Actually, today's webinar will be focusing on the position management, as we said. In general, it is about calculating position size along with the targets and stop loss levels. And we're going to touch, of course, the impact of trader psychology as well, okay, because it's a significant part of position management. And you can say, why, Andrea? What our psychology has to do with finding out and calculating the size of the position? It does. It does, because if the size of your position is huge, okay, because you might got greedy and you want to gain money fast in a single trade, etc. This is greatness, and this is an emotion which, unfortunately, as human beings, we have greatness in our blood. So it's the way we have been created or something. So yeah, position management is about risk detection. Okay, so that's why um, studying the psychology of the trader and study the way that and calculate the position size will help us risk a reduction in the risk. Okay, reduction the risk of losing our money or a big part of our money, and etc. So we will study. We're gonna see together how to reduce risk and then how to add into winning positions, when and how to do this. Okay, so this is important because it's not a matter of reducing risk, but it's also a matter of how you can add into your existing winning positions. Okay, so and how you actually can achieve that, how you can do that. So um, um, So why would someone want to add into positions, existing positions, rather than reduce a trade size once there is some profit, right? Okay, both sides, I mean, adding to positions or trying to reduce trade size, both aspects is what we're gonna try and cover today. But I'm gonna take it step by step, okay? So here we are. So let's take it step by step. First of all, let's touch the very, very big topic called psychology, and more precisely, trader psychology. There are actually people, economists, analysts, in general, people that believe and support that trading is 99.99% mental, a mental process, and only a very little tiny fraction of this of the trading is a physical process. So 99.99% is a mental process. It's just the not 1% is a physical process. And by physical process, we mean literally when you take your mouse, you do your analysis, you go through your trading plan, okay, you follow your trading plan, and you open a position. So that's the physical process, and all the rest is a mental process. So that little moment, guys, okay, that you click the button, you click the mouse, which is a physical involvement, right? Physical involvement. there is obviously you need to be in order to do this action. I mean, this might sound a bit weird or even funny, what I'm trying to tell you, but listen and you will understand what I'm trying to say. So literally, in order to do this process, I mean, to click the button to open a trade, you're doing, it's a physical involvement, right? That obviously it needs to be done once you're awake, once you need to be healthy, in order to do your analysis and click the button and open a position, right? You need to be well rested. You need to have enough food in order your belly to be actually okay and sit on the screen and be awake, um, in order to have to have the physical to be physically good and healthy, in order to sit down on your PC, do your analysis with a clear head, and proceed with clicking the button and open a position, right? It might sound stupid, but what I'm trying to tell you, okay, what I'm trying to basically make you understand is that in order to be physically fit, but most of all, um, uh, so in order to, like everything in life, not solely trading, like everything thing in life, in order to achieve something or to do something, okay, open a business, or do your workout, or I don't know, to go for a walk. Everything in life needs physical involvement, right? But in trading, most of all in trading, most of all in trading is about psychological, to be psychologically okay rather than physically. Now, my first question in this is, and you're gonna get the point of why I'm referring to physical involvement and psychological involvement. Why I really focus on the of being of feeling of being okay psychologically, etc. So with this question, you're gonna understand where I'm taking it, this conversation. So one quick question: do you value your money? Do you value your money that you have for trading? Anyone? Can anyone reply to me? Do you value your money in trading? So much, exactly, Michael. I think everyone of us. There are people that they are very rich. They do it as a hobby. They don't care. They're doing it as a game. But obviously, I don't think they are making any profit, because they don't. You don't behave trading like it is a game. Trading is a business, and if you want to do it properly, you need to value your money. So if you do value your money, and I believe that most of you're valuing your money, then you do trade. You need to do trade professionally, and you need to manage your positions professionally. The sad truth is that the most of the traders don't really listen, don't really they don't really agree with this perspective, with the fact that you need to trade. If you value your money, you need to trade professionally. You manage your positions professionally. If you don't do that, then you deserve to lose, because you are really don't behave like you want to succeed. So yeah, there are lots of people that they don't really agree with this statement. So, and there are a lot of people, a lot of traders that they behave to trading like it's a gambling, but it's not. It's not. There are there is a fundamental analysis, there's a technical analysis, there are tools to eliminate probabilities of losing. It's like a business. Once you open will you open a shop if you don't have a business plan, if you haven't studied whether this will succeed or not? You will, right? You do your business plan before opening any business. So you should treat trading the same exact way. Okay, so yeah, most of the traders, they don't really care about learning how to get disciplined with their money. And in order to be disciplined with your money, to be disciplined with your in trading, etc., it's a matter of risk management. It's a matter of position management, and most of the traders that are actually coming into this arena, uh, the very one of the very first things that they need to do is emotional control. Okay, emotional control. All of us, I mean, all of the traders or that are coming into this arena, they are thinking about big, huge profits, right? They think about that they think that they can just come in and they will make lots of money, and but that's not the way. This is this is a gambler's mentality. Okay, so um yeah, if traders are, and if people are coming into I want to become traders, and they just have the mentality of, oh, I want to gain, I want to be a millionaire, I'm gonna gain millions, I'm gonna so I can throw in trades that are oversized and etc. in order to have fast returns, etc. That's nonsense. That's nonsense. Uh, so um, this is the gambler's mentality, and yeah, that's not the way. That's why if you hear people claiming and saying that, oh, I lost a lot of money, and um, probably they didn't have a plan, probably they didn't have a strategy system, probably they haven't done the um, the necessaries. And by necessaries, they haven't really managed their positions. They haven't managed their risk, and they somehow expect to make huge amounts of money, which is something ridiculous, right? So treat so profession works like this. You need to be disciplined, you need to have a plan, you need to follow your plan, you need to manage your positions, you need to manage your risk before entering the market. Um, so it's not like walking in the door and do whatever you feel doing without actually be serious. Just enter into the door and just driving by your emotions, by excitement, and just do whatever comes into your head. It's not like that. You have to learn. Uh, you have to learn um, before entering this industry. You also have to learn from your mistakes, the things that you have that they went bad, and uh, im- how uh, to overcome these mistakes. Okay, and that's why emotions is key over here, because because in trading, emotions basically dominate. Okay, so you need to stick on. Many times we're saying that you need to stick on what you see and not what you think, and this is what we mean, because as human beings we're driven by our emotions. It's a very difficult thing to try and focus on um, what we see other than what we feel or think. Okay, so so yeah, So let me just yeah, so we need to have a clear plan, a clear strategy, a clear system in which you can create yourself, like in a demo account maybe. Okay, you don't need to be live, and following a plan, like strictly following the plan that you have created and you have seen that it works for you, this will immediately save you of being driven by your emotions. Okay, so because if you don't do that, you will end up like feeling the same things like a gambler is feeling. So having this gambler's attitude, um, and not in a positive way, because a gambler might be someone that is saying that, oh yeah, I'm gonna gain, oh, I'm gaining lots of money, yes, I'm gaining, but once it's losing money, is losing control as well. And then the worst are coming, because if you have the gambler's attitude, um what usually is the case, that if a gambler is losing money, is in a panic, and what it does is most of the time increase the position size, or take stop out further down in order to, because he believes that at some point it will the trend will turn on his benefit, and say, okay, let's leave it open, let's leave the position open, eventually it will come on the direction that I want. No, that's not the case. That's not the case. Okay, and um or yeah, that's usually how, it's the panic, it's the panic emotion that makes people overreact, or uh, being blind sometimes, and believing that eventually it will turn, and etc. So so discipline is a key word, and is a word that can be achieved, is a thing that can be achieved if you have your own trading plan, that you have excellent, you have done a really, really good trading plan in a demo account. Why not? In a demo account, you have worked on it a lot of time, and you have managed to create a very, very nice trading plan for yourself, for your time frame, from your including the momentum indicators and oscillators that you understand, etc. And if you follow your plan, then you will be you will have discipline in your training as well, because following your plans means that you won't be emotionally driven, okay, because you follow your plan. So if it if it if it ends up with a profit, that's great. If it ends up with a loss, it's okay, because you have already calculated in advance that if something goes wrong in that position, it will be just $10 from my account, let's say. So you have calculated already how much you want to risk. So for calculating in advance how much you want to risk, it means that you are okay on losing that amount if something happens and coming against your and the trend comes against you. Okay, so um uh so what else, so just before we actually see in a practical way, in a more practical way, how you can manage your position, I would like to um give you an example. Give you an example. um so we in a risk management webinar that I had in the past, and a money management webinar, I correlated the trading with sports. Why did that? Because being an athlete, okay, um, because you are a runner, you might be a runner, you want to succeed in the Olympics and etc. Being an athlete, um, the key thing of being a successful athlete, okay, is practice, right? Practice makes perfect, isn't what they say? The same thing stands for trading. Okay, that's why we offer demo accounts. I mean, that's why the demo accounts insist. So practice makes perfect. So like an athlete or like musicians, it's not all about the physical involvement. It's also the preparation part, the practice, but also the emotional involvement as well. Because, like athletes, okay, one thing is practice, 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 practice. The other thing is also uh, the sentiment, the emotion that, okay, if you practice enough, you feel confident. If you feel confident, you can achieve anything you want, right? So, so, um, and athletes have a plan as well. I mean, they have their daily uh, performance, their daily practice, right? Day after day, trying to get better and better and better and better. So they have a plan. They have a long-term plan. They have a near-term plan. They practice themselves as well, and they feel confident day after day, more and more confident in order to enter the arena with a good emotion, with a good like sentiment, with confidence and prepared. Okay, to stick to their plan as well. So yeah, and athletes is just one example. Okay. um, but you understand that without a plan, without preparation, the only thing that um, will dominate is stress. Is stress. Okay, so if someone is not prepared like an athlete, it hasn't really practiced and just show up in the marathon, let's say, to run, obviously his stress and the fact that he's not physically prepared will end up with him being last or at the very last few people um, in the marathon, right? So organization, um, practice, having a plan will get you better in life, but also in trading, and will lead you into better decisions. Okay, which in trading is pretty much translated into higher net profit in your account, right? So slowly, you're gonna grow your account with patience, confidence, and sticking to your plan, controlling the bad emotions such as stress, such as panic, and etc. And greatness, of course. So very important, this is a very last bit of this slide, very important is to stick to a routine, to create a routine. So if you follow your routine, okay, that you've created each yeah, that you create based on your workload and etc. If you create a routine, okay, then it will fit you back with as more confidence as you need, and as more self-appreciation, and the self-appreciation will grow. You're gonna believe in yourself, and you eventually will be more capable of reaching the goals that you have in trading. So if you believe that you have you more likely to achieve them by increasing confidence, and this confidence can be increased by generating professional ways of handling things, whether it's trading or another business, or whether you are training to be, I don't know, an athlete or a singer or whatever. So yeah, you need to treat things in a professional manner in order to achieve in anything in life. Again, whether it's trading or something else. Okay. So um so let me check a bit the questions. The line is breaking, madam. Hopefully it's not breaking anymore. Let me know if it still does that. Um, uh, so, okay, here we go. Let's move on to the next slide. Position, management, and let's go now to the more like fancy and interesting part of the webinar. So to the position management and how you can do it, how I can help you get rid of the fear and all these uncomfortable feelings, and how you can actually manage your position. Okay, so one, by managing your position, it means identify reasonable exit levels. So that automatically, by identifying exit levels, that automatically um, makes you feel like better, because if you're better positioned, then you will get rid of feelings like fear. So how we can do that? We're gonna go through some calculators that will help you calculating actually your position. But before we do that, we're gonna see it in practice. Okay, so see it in that's breaking. I think my network was weak. Okay. So anyway, you're gonna have the recording, so don't worry about it. So so let's have a look on the MT4. Okay, let's basically do an example in order to see how you can manage your positions, and with this way manage your risk, which is obviously a very important thing to do, and it will help you like controlling your emotions, etc. Um, so let's start with this one. So we have, I just put randomly out here the dollar yen 1 hour 1 hour chart. Okay, um, so I'm gonna use a very simple concept over here. Okay, very simple concept, and the very first thing that I'm gonna do is have a look at my candles to figure out the direction of the dollar yen, right? So let me actually clear a bit, get rid of, let's use a plain initially chart. Okay, so here's the 1 hour dollar yen. So I need to understand firstly, the very first thing that I need to do is to understand them, to find out the direction. Okay, before we decide on what kind of trade we're gonna take, or when we're gonna enter the market, where we're gonna add our exit levels, and etc. etc. So sorry, I need to drink some water. So what we need to check, we need to see how we need to study a bit the price action. So what we can see over here, I'm gonna put some irons if I can, some lines. So I can see that the market came down over here, having a low. another low over here, but in line pretty much with the previous one. Lower low over here, and another lower low over here. So continuous lower lows. The upside, I can see something different, similar, but with lower highs. So by observing this, okay, I understand that the market is making lower lows, right? Starting from here, because initially it was up, starting from here, but it's also doing some lower lows, highs as well. So this is one way of recognizing the market direction by observing the lows or the highs in the market. So by seeing this, we can see that the market is moving downwards. Okay, it's moving, it's in a decline. The asset is in a decline. The dollar is in decline because we are getting lower highs, lower lows. Okay, so what that means, it means that the market action tell us that buyers are not really interested in taking the market higher, but sellers took over and they are pushing the asset, the dollar yen, downwards, right? So another way to identify the direction. So I think that's you're okay with that. I mean, you are traders anyway, so that's the one way of doing it. Another way of doing it is maybe using some kind of a moving average. So let me put my intraday analysis, my intraday setup on, which looks a bit messy, but just so I'm gonna delete that. So moving averages are also helpful for identifying um, the um, um, whether the market is trending lower or is trending higher, and etc. So one way to do it is using moving average as well. So or using okay, so I have over here is a 5 and 9 exponential moving average. I have the 20 moving average as well. So you see that the moving average, the 20 moving average, is keep pointing downwards. Okay, the same stands for 50-day period moving average with the asset with the price action below it since Monday. So with this way, we see that we can figure out, it's a different way to figure out where whether the asset is moving lower or um, is in an uptrend, etc. Another way is to use to check different time frames as well. So here we have the 1 hour time frame, right? We have obviously identified that this is moving lower. The market over here is moving lower, right? It's going lower. Then you can just go one step backwards. So in a lower time frame, so since I am in the 1 hour time frame, I will move down to the 30 minutes time frame. Okay, here we are. So we're gonna have a look into smaller time frame. Why is that? Because if you check the exact um, the next lower time frame, okay, you can easily identify whether the downtrend that you have seen in the 1 hour chart has faded out or whether there is further strength to continue on the same direction, which in this case is further downwards. Okay, so looking into smaller time frame, okay, it helps you identify, it helps you first of all get confidence whether you it's a good idea to go short. Okay, so it gives you confidence, but also it gives you clues about the sentiment, whether indeed there is still strong bias to the downside. Okay, so um yeah, and because it might be if you went down to a lower time frame, you have seen that it gives you more of a bullish signals than bearish signals. That means that maybe this decline, this downtrend has run out of steam and the asset is ready to reverse. So if you go short, then you will end up fighting against the market, which is something that you don't want to do, right? So it's good to, if you, okay, this is just an example. Obviously, I started with the 1 hour chart and I went to the 30-minute chart. Of course, this can be this kind um, of way to identify the direction and whether and whether it's a correct decision could be applied in other time frames. So, for example, if you are a trader that trades in a 4-hour chart solely, okay, you will get a step backwards to check the 1 hour chart. If you're a day trader, you will take a step backwards and check the 4-hour chart. So one time frame lower. So so this will give you confidence, guys, to make sure that the decision that you have taken by doing all the necessary analysis in the 1 hour chart is indeed like a good decision or not. Okay, so um, mm, because you shouldn't really fight against the trend, right? um it's trend is our friend. So studying also other time frames or lower time frames will give us, as I said, a clue on whether the trend is still on, is still strong, in order to go along with the trend. Okay, this is a very, very simple idea. It's a way to uh, maybe something that you haven't really tried in the past, and you it's just an idea, a thing to an idea to make you feel confident about your decision and to confirm your initial decision. So as we have seen over here, we have firstly, first of all, we have seen in this 1 hour chart that the movement is down. Yeah, then we went to the 30-minute chart, and what we do over here is obviously the same thing to check whether the markets keep moving lower, or whether something change and the trends rolls over, etc. So the question here is, where do you want to um, um, where do you want to go, and where do you have enough confirmation in order to actually open the trade? Okay, so that's why I went a step backwards. I went to the 30-minute chart. So let's study a bit what's going on over here. So the asset right now, after a very sharp decline in the early this morning, is sideways. Can you see that, guys? So it's moving sideways, right? So what you have to do right now is to gain enough information in order that will confirm you that indeed the trend will remain to the downside, that the momentum is downwards. Okay, so usually I'm usually focusing on areas like actually what I'm usually tend to do is just study first of all my candles to see whether they are ranging. I have a ranging market or trending market. So what I have right now is that it did have something similar with the 1 hour chart. So lower highs, lower lows. But right now my asset is moving sideways. So by having these lines on, I put some barriers in which they will give me a signal whether the asset will rebound or it will drift further to the downside. Okay, so that's that will help you, because a breakout of this lower level, the lower barrier, it will be a confirmation that the asset will continue downwards. Or another way to do it is once again to check your moving averages. Okay, indeed the asset is moving below 20 period, 50 period, 200 period, even my very short time frame 5 and 9 exponential moving average. So that's another clue, it's another confirmation that there are more sellers than buyers in the market. Okay. Or okay, you don't have to do all the things, these things that I have over here, but just giving you ideas in order to confirm your decision on going short because of the downtrend channel that you have seen in the 1 hour chart. So another way is just yeah, it's moving averages or poorly priced action, or checking also momentum indicators such as MACD, which remains negative. So that's another confirmation. But yeah, it's a very tricky to figure out when you have enough confirmation. So the more indicators you have, the more messy will get. So stick to um, stick to price action. What I mean with by saying stick to the price action, that range, that those trend lines that I have put on this recent latest movement were enough, because as I said, the breakdown of this low over here will be enough confirmation that indeed the asset will continue further down. If I will give you another example over here. If, for example, here, okay. So let's assume that we had this drift, okay? We have this boost, but posting a lower high of the asset. And we were thinking whether this is a reversal sign or whether it will get back down again. So what you should do in this case, again, connecting the highs and the lows and creating some other uh, immediate support and resistance levels, which if they broke, it will mean that the asset will turn back down again, right? So, okay, that's not an ideal example, but actually that is. So here it is. So here it is, because on the breakout of the lower trend line, and with a decisive candle like this one, that was a confirmation that the sellers are back on and the asset will continue downwards. So there are very, very different ways to do it. These are some of them, okay? It's pretty much up to you which one you want to apply. It's just give you some simple ideas to gain all the necessary confirmation informations that you might need from the 30 minutes chart before entering before proceeding with your decision to go short, for example, in the higher time frame, which is the 1 hour chart that we initially study. So finding where the market has found some kind of a support, so finding these immediate support and resistance levels, then that will help you identify breakdowns that will confirm you the sentiment. Okay, so so now what we're doing, we have identified the direction, we have identified also the sentiment in the lower time frame in order to have a confirmation of our decision, right? Now we need to decide when to enter and exit levels. So to create our own, to set in advance, to do our position management. Okay, so prepare before we enter the market. So how we do that? First of all, if you noticed, from the 30 minutes chart over here, we have seen that the market is trending sideways. So I have set up these levels, these resistance support levels, in which they can help me identify a potential entry level. Okay, so either on the breakout of this bottom or further down to that one, which is the latest low. So that will be, if the asset breaks down, will be our a great entry actually for a short position, right? So that's okay, I think, right? You're okay so far, guys, right? So yeah, but our webinar is about position management. So how we can achieve how we can do our own position management before entering the market. Position management has to do mainly on where you're setting your stop loss and your targets. Okay, so there are different ways to do it, and one way to do it is by using as a measure the ATR indicator, which ATR indicator is over here. Can you see that? So let me delete the others. Okay, perfect. So so one way is to use the ATR indicator, which is basically measures the range you have average, the average range of the previous 14 sessions, okay, and gives you an average price. So ATR is widely used as, and the multiples of ATRs, it could be used as target levels or stop loss levels. So in general, as exit levels. But okay, let's see that. So we have seen that is ranging. We have set a resistance line, the barrier, the top barrier of the range is our immediate resistance line. The and potential entry is at the support level, the latest support level 121.29, right? So ATR is at 25, not is not 0.254. Okay, so here's where the so now is the time to get our position calculator. Okay, so I'm gonna bring the position calculator. So you need to open your, just let me bring the, you need to open the website, right? The Hot Forex website. Actually, I'm gonna, okay, I will take a step backwards, okay, and see what happened here in order to see actually an actual example, because now that is still within the range. But let's assume that we have been over here, okay? We have seen this breakout and we decided to enter, okay? And the ATR at that point was at 0.245, okay? And our entrance was on the close of this candle at 123.21. So you need to bring, as I mentioned earlier, the position management, the position calculator, which you can find in the tools over here, trading calculators, and risk percent. Here it is, risk percentage calculator over here. So we need to select the asset that we're trading, and let's assume that we have seen this breakdown and we have opened a position at 123.21. So 123.21, sell short position. So according to ATR, that is the average movement is 24 pips, right? 24 pips. So the mask. So basically, using this indicator, this risk percentage calculator, okay. Basically, you need to choose your maximum risk per trade. But first of all, you need to choose, as we already seen, the currency, the account currency, the pair that you are about to trade, to set up your open price, the direction of your position, and we need to put on as well our balance, the percentage that we want to risk, how much money, how much of our money we want to risk in this position, along with the stop loss, um, along with the stop loss level as well. Then, the so so you need to take a decision over here in regards to the stop loss, okay? So we have enter over here, and the ATR was 24 pips. So so you need to decide whether you want to use the full ATR value, okay, or whether you will use the half of it. Using the full of your ATR, it means that you need to set, if this is your entry, you need to set up your stop loss at 24 pips higher, which is over here at 123.46. So over here, over 46. Here it is. That should be so. Okay. This is the full ATR value. Okay. So let's get back to our calculator. So our stop loss is at 123.46. It should be. You need to measure, let me do the math. So 123.21 minus 0.245 equals 0. Plus not 123.21 plus 0.245, which is what the ATR is telling us. So yeah, 123.46. That's correct. So we have used the full ATR in order to choose our stop loss. Okay, on a short position. Okay, so let's put the balance of our account. Let's assume that we have $100 over here, and now the big decision. Big decision is how much we want to risk. By the way, before we say about the risk, you don't necessarily need to use the full ATR. That's up on you guys, okay? There are people that they might use the half of it and so on and so forth. But yeah, as a stop loss, a full or the half of the ATR is quite a reasonable level to be considered, depending, of course, on the asset, on how close it is to on the time frame, etc. Now, now the big decision is how much you are willing to risk, and this is all up on you. You need to consider that if something goes wrong, how much am I okay? I'm feeling okay to lose. So me as Andrea, let's say, if I have $1,000, only $1,000, then I wouldn't risk more than 1%. I wouldn't. To be honest, I will have put around 0.5% or no, sorry. So I will be like around 1 to 5%, because that means that 1% of my balance, so I'm risking only $10. If I go 5% of my balance, it means that I'm risking $50. So yeah, that's up on you. You need to put a percentage in which you are feeling okay losing, because something might happen. A central banker might come out and say something, or data could be out and everything will change. So you need to put the percentage that you are okay losing if something goes awfully bad. Okay, so how the percentage of the money that you are willing to risk. Okay, so let's calculate. What we calculate is, so it gives us, in order, what's important is that it gives us the stop loss in pips, but anyway you knew that because you use ATR as your so you use 20 near 24.5 25 pips based on the ATR, so you knew the stop loss in pips because you've used the full ATR. But what is important is that it gives you the lot size. So when you're coming over here to open a trade, okay, and you will put your stop loss at 120. Come on, you trade at 123.46. Okay, over here in the volume you have, in order to risk only $50 of your amount, you need to put this result, the lot size. Okay, so over here you need to put 1.20, how much was it, 1.24, in order to be sure that if something goes wrong you're gonna lose only $50 of your account. Okay, so this is what we call position management. Calculate in advance, prepare in advance your position size in order to uh, risk a particular amount of your account, okay, only for each trade. So you have decided that you're okay risking $50 of your account, then by adding and filling up the risk percentage calculator and use this lot size, then with this where you know that you're risking the $50 of your account. Okay, something that you have decided in advance. Okay, now so this is something that is not really new, because if you have created your own strategy in your own system, then you have obviously set in advance the risk, the percentage risk per trade. Because I don't know how many of you have seen our trading plan webinars, but a significant part of creating your own plan is to identify, not identify, actually figure out and decide in advance how what's your risk percentage per trade, what's your risk percentage per day, or even per week or per month. So how much money you're willing to risk per trade or in a single day, and etc. Okay, so if you have created your own strategy system, okay, you have already a certain amount of money that you are willing to risk per trade. Okay, now so we have seen how the risk percentage calculator helps you to identify the appropriate lot size per trade, right? And you see, so the thing is that if you see, the more you're risking, okay, the more you're risking, the different the lot size will be, or the higher, the far away the stop loss will be, okay, then again the automatically the lot size changes as well. So yeah, that's just for your own information. So it depends on what you want to use as an entry level, what you want to use as a stop loss level, and as what you want to use as a risk percentage, and etc. Now, let's move on. Let me know if there is anything, guys, that you don't understand. You have been quiet for a quite long time, so I'm quite worried. Are you okay so far of how risk percentage calculator help us with doing an appropriate risk position management before taking an entry? Anyone? If you're okay, I'll move on to the next demonstration. As we have seen as we have seen in the webinar that was precisely for ATR. Okay, you can use ATR again for identifying also your target levels as well. Okay, so have this in mind using the ATR as target. So that means using the full length of it or multiples of ATR to identify the target level. So that will bring us to 122.95, or twice the ATR will give us down to should be somewhere over here. Let me just measure it. So 25 multiplied by 2, that's 50. So the next, yeah, should be somewhere here. So these two, let me put it in different color. So using ATR is another way to it's a way to set up your targets as well. So the multiples of ATR. I think I covered that these topics like in the when I demonstrated the ATR indicator. So of course, each one of you has different way of setting his target levels, either using ATR or maybe using fractals as targets or Fibonacci levels, or it's up on you. Just an idea, okay? So let's move on. And let's move on to the next step, which is to another indicator that is really helpful with position management as well is the multi-target one. So let's once again tools, trading calculators, and here we have here it is. Let's use that. So we are in a dollar yen with account currency dollars. We have taken decision to go short. We have calculated already using the risk percentage calculator that the lot size will be at 0.24, right? 0.24. Our entry was at 123.21, right? That was, and the stop loss that we decided to set, it was the full ATR number, which is 123.45. Is that right? So now target levels. Setting up different target levels help you guys lock in profits. Okay, what I mean by that, there are many I'm not sure whether you have noticed that the market might went initially on your direction, hit a particular a resistance or support level, and then reverted. Okay, so adding multi-targets, and with this way splitting also the risk, the lot size, splitting the lot size as well. With this way, you can lock profits. What I mean by that, it means that if the target, for example, if the asset moved to the first target, okay? So it reached the first target, okay? And afterwards, it quickly, without really touching the second potential target that you might have set. So after breaching the first target, it reversed upwards, okay? Then with this UOA, you have already locked the profits from the very first you have locked these profits from this movement from 123.20 to 122.95. So this you have already closed and locked the profits from this movement over here. Even though afterwards it reversed, it doesn't matter because you have already locked the profits from this initial move over here, even though you haven't really hit your second target, etc. So having multiple targets in your positions, okay, you can gain the best possible return to risk ratio. So by exactly with the way that I have just what's happened? Okay, exactly with the way that I have just mentioned, by locking profits every time that your asset it has reached your target. So so even if you believe that it has the potential to move down, further down, and maybe reach the 122 level, for example, which is far away, even if you have this view, by using multi-targets, you are detecting the risk of um, um, you're detecting the risk, because as the market moves on your favor, you are locking the profits. So if at some point it turns against you, you have already locked your profits. So it will not, you will end up with a profit rather than a loss, because you have benefit on this on this movement towards your target, your final target. And even if it reversed, you have already gained that. So it will just close the position automatically. So let's assume that we have used ATR as our we have used ATR to identify target levels. So target one was a full ATR. Target two, actually target one is a twice ATR, because we have a risk and reward ratio 1:2. So target number one is 122.70. Target number two should be 3 times the ATR, so around 75. So it should be somewhere here. So let me just be 75. So 122.45 should be at 122. 122.45. And my final ATR will be, let me put the 1 hour chart. I am here. So my final target will be either using ATR or using fractals and etc. That's up to you, or using Fibonacci levels and etc. So it doesn't matter. I'm gonna use ATR. This is example. Demonstration is up to ATR. So I have used as my first target twice the ATR, the second target 3 times the ATR, and a final target 4 times the ATR. So let's put this on. Where are we? So here we are. So let me delete that. So these are my targets. Let's change the color as well. This is just to give you ideas, okay, guys? Okay, here we are, final target, and let's put everything on the calculator. So 122.70, 122.45, 122.23. So lots closed It means that you need to decide how much you want to risk on the very first target, on the second target, on the third target. So our lot size is 0.24. So I want to have 60% of the lot size in the very first target and the remaining 20, another 20 on the other two. So that means 60%, that should be, I should have 0.15 lots over here, okay? And another 5 here, not 5, and not 4 over here. So calculate. This means that, so let me just check something. Oops, I forgot to click that I'm going short. So here's the short, calculate. So that means that if my asset hits the first target, I will profit $62. If it hits also first and second target, okay, I will gain around $93, $94. If it hits all of my targets, it will give me a profit of $126. So look at that. Even if it doesn't hit the second and third target, okay, the worst case scenario is that I will break even, okay? But if it hits the first two targets, but not the third target, I will still be on profit of around $60. Chima, depends on your risk and reward ratio that you want, okay? Depends on the risk and reward ratio that you want. If it depends, yeah, it depends. So if, for example, you use double in this scenario, okay, let's assume that you use double in this scenario. Double means that you are stop loss is somewhere around here, okay? So you have what, 1-to-1 risk and reward ratio. So you are risking the same amount that you want to be rewarded. Okay, so the risk is higher. It depends on your risk and reward, but yeah, you need to the closest. Okay, it doesn't have to be. Yeah, I think for stop loss, a single ATR is just fine. Depends, of course, on the asset. Depends on your risk and reward and etc. Yeah, but far away stop loss is just increasing your risk as well. So yeah. So how can I record of the program? You don't need to record it because you're gonna receive a recording once we're done the eSkill. So by the way, Chima, you asked about the ATR. It's just a demonstration in which I used for identifying my stop loss and my targets ATR, but it doesn't have to be that way. You might, I don't know, let us know how you are identify your stop loss and targets. Which indicators or tools or analysis are you using? So if, for example, okay, I'm using my fractals as trigger levels. So the latest up fractal was up here, so I could use this as stop loss, but over here my targets, the latest up fractal that I have is down to the very first target that I have is down to here 122.45. So, or you might using over here Fibonacci's as your immediate support and resistance levels, and as a consequence, your potential target and support levels. Or you might consider using using the peak of the candle, as your stop loss. So since you have taken an entry over here at the bottom of this the close of this candle, so you might consider as a stop loss just a few pips above let me zoom in a bit, just a few pips above the high edge of this candle, which also coincides with the 38.2 Fibonacci level. So this is basically on you need to adjust this based on on the system that you're following, on the strategy that you have. Okay, that was just an idea in order to demonstrate you these two calculators that will help you doing an appropriate position management. Okay, so don't stick to the fact that I have used ATR. It's just for demonstration purposes. Each one of you has different ways to identify target levels and stop losses, but just make sure that the risk percentage that you're gonna use is wise. I mean, you don't risk, 80% of your money, or you're risking a precise amount that you are okay losing, like we did over here. Remember, I use only 5%. 5% of 1,000 is $50, so I'm okay losing $50 if something goes wrong. Okay, so this is what matters over here. Using these kind of indicators to do appropriate position management. And we're nearly reaching to the end of our webinar. The last thing that I wanted to by the way, another thing I have not sure whether you have noticed, but in the multi-target the tool, sorry, let me put everything again on. Short 1, 2, 3. How was it? Point 21. Then that was the entry. Sorry, entry. My lot size was 123.45, and that was my stop price. The lot size was at 0.24, and let's assume that I have just a single target, and my target is down to so let's do that again. So it was twice. So stop loss was here at 123.45, and let's assume that I have just a single target. Okay, oops, and I have chosen as my target the 61.8% Fibonacci level. Okay, why not? So 122.65. Okay, I want to show you something. 122.65. So I put the full lot size over here because I have a single target. Calculate and over here. So can you see that in this table, other than the profit or potential loss that I might have if once the price hit my target, or if it turns against me and kicks my stop loss, I have also the risk and reward ratio. So I'm risking more than double of my return will be more than double of what I'm risking. So return to risk ratio. Okay, so this way you have the risk ratio as well. So yeah, so guys, any questions before we just before we pretty much I demonstrate anything else? Any questions? Something that you want to check, because we're nearly to the end. So I pretty much covered everything that I wanted. Okay. So So just before we end the session, what I would really like to clarify over here is that you need to be careful, first of all, with the risk percentage that you are gonna set, but also on this split over here on the lot size split. Why? Because let's assume that you have decided to take to put three targets, okay? I'll just randomly put some, okay? I have the 122, 123 as the very first, 120 to 65 second, and 120 to 20 as a the third one, okay? But instead of wisely splitting the size of the position, I decided that I have put just 0.05 on the very first target, 0.05 on the second target, and nearly 60% of my position in the very last target. So that's a big mistake. Why I'm saying that? Because once you hit the first or even the second target, you will end up with gains around $30. Okay, $30. So if it turns against you, okay, if it turns against you or never touch the third target, what you achieved is pretty much nothing. I will say. Okay, so you need to, because if this turns against you, okay, let's assume that you have set your three targets, and the third one you have set the biggest portion of your position in the very last target. If the asset for some reason comes against you, then you're probably gonna suffer $116 loss rather than profit. That's why you should do it vice versa. You should the biggest amount, the biggest percentage of your position should be set on the very first target that rather than the last one. Okay. So so hopefully, so let me see the question, please. I came late. Could clarify on the multi-target. It is what exactly? Chima, which asset are you looking? This is, yeah, if it's I'm not sure what you're looking, but for example, in this dollar yen, remember, is set up in 3 decimal places, right? So the fact that it's showing me 0.25, that means 25 pips. Okay. So no, which one are you're checking? Aussie New Zealand. So Aussie New Zealand, here it is yeah, it has 5 decimal places. So and your ATR is saying 1,000,11. So that means 11 pips, not 110 pips. Okay, 11 pips. So you need to measure up to the 4th decimal place. Okay. How will know the favorable lot size to use for our trades? It's exactly how we demonstrated. You need to use the risk percentage calculator in order to give you the lot size based on the risk percentage that you have already chosen. So remember that we have tools, calculators, risk percentage. So remember, dear, who is Iskil, that I have set everything. I have put my open price, the direction. I have set my stop loss. Okay. I have set the balance of my account, and I decided that I don't want to risk more than $50 of my account. Okay, so I have put, so $50 out of 1,000 is 5%. So I'm risking only 5% of my account. By calculating, it gives you the lot size, the appropriate lot size in order if the market turns against you, you will lose only the $50 that you have already pre-decided. So that's up on you. You need to fill um, this form, and it will automatically calculate the lot size for you based on the risk percentage. What is the advantage of this multi-target to trailing stop? Nice question. So with trailing stops, you are actually locking profits. So if you have set multiple targets, put in your position, but instead of a fixed stop loss, you have set that, you know what, I'm going to use a trailing stops just 10 pips above my price. So this means that the stop loss will move along with the price. So the stop loss will move down as the price moves down as well. So this way you're locking profits. So it's a good combination. Okay, guys? So any other question before I call it a date? So if there are no other questions before I call the date, yeah, I have already uploaded the handout, even though it's not so helpful. You need to again see the recording in order to help you with your position management. But yeah, that was pretty much from me today, guys. Okay, it was pretty much a lot of demonstration rather than slides today. So if you have any question, just send me an email at webinars@hopefirst.com, and I will try reply as soon as possible. Okay.